If you've ever looked at your profit and loss report, seen a big number on the bottom line, and still thought, where did it all go? You're not alone. It's one of the most common frustrations I hear from all types of business owners, but definitely veterinary practice owners as well. You're working harder, producing more, your clinic is busier than ever, but somehow you're still not seeing the financial payoff you expected. The truth is, as your income grows, your tax bill usually grows faster, unless you're proactive about how that income is structured. The IRS rewards planning, it rewards timing, structure, and strategic use of the tax code, not the last minute scrambling. So, in today's live training, I want to walk you through 5 practical ways to keep more of what you earn, even if your tax bill seems to creep higher every year. We're going to talk about real strategies that work for veterinary practices, how to leverage retirement contributions for both tax savings and long-term security, how to control when your capital gains show up, how to use state level credits most business owners overlook, and how to stop reacting at tax time and start driving your own financial results. Um, Bear with me for a moment. I'm getting some error messages. I need to make sure this is working correctly. Looks like it is, but yep, there we go. All right. So, and I do have some slides. So today we're going to dig into 5 key financial strategies that significantly change how much money you actually get to keep. Hang on, sorry, I can't talk and share at the same time. Slideshow. My Zoom. Mm. Um, each of the different strategies is going to connect to a different part of your financial ecosystem, your income, your investments, your business structure, and your timing decisions. There it goes. This is about taking control of your financial picture instead of letting the IRS or the calendar dictate it. When you understand these levers, you can make every dollar in your business work twice, once for you now and once for your future. So for those of you who are new here, I'm Cassie Sykes. I'm an enrolled agent and owner of Greener Pastures Income Tax, based here in East Texas. I work with a lot of veterinarians and practice owners across the country, from startup solo doctors to multiple location practices, helping them understand their numbers, lower their taxes, and improve cash flow without overcomplicating things. Over the years, I've seen practice owners pay way too much in taxes simply because no one ever explained their options. My goal is to change that, to make sure you understand not just what's happening on your return, but why it's happening and what you can do about it before year end. So the first step is to maximize retirement contributions. So the most foundational move is strategic retirement contributions. Most people think of retirement accounts as something you should contribute to, not something that can actively change your tax position. But for high income veterinarians, the right plan can literally shift tens of thousands of dollars from taxable to tax deferred. There are layers to this, of course. If you're a sole proprietor or single owner S Corp, you have options like a solo 401k or a SEP IRA. These let you contribute both as the employee and as the employer, meaning you can often put away far more than the standard personal IRA limits. For larger practices, a safe harbor 401k or a profit sharing plan can not only build your own wealth, but also double as a staff retention tool. You're reducing your own taxable income while creating benefits that help your team stay loyal, and both are deductible. Here's where strategy comes in. You can time contributions to hit in the same year as large gains or bonuses. You can also combine different types of plans for greater flexibility. For example, funding a pre-tax 401k and an after-tax Roth bucket for long-term balance. You can also retroactively set up certain plans if you act before your tax filing deadline. What I often see is practice owners waiting until the year is over, then saying, let's see how much I can contribute. By then, most of your flexibility is gone. You want to plan during the year when you still have time to adjust payroll, shift income, and decide where those dollars go. The result by doing that is less tax due in April and more long-term wealth building automatically happening behind the scenes. The second strategy, and this is where a lot of high income professionals lose money without realizing, is capital gains. It sounds simple. You sell an investment or a piece of property, make a profit, pay tax on it. But the timing of when those gains are realized makes all the difference. For veterinarians, this often comes up with the sale of old equipment or vehicles, the sale of a rental property or building you personally own but lease to your practice, or even selling part of your investment portfolio to fund renovations or expansions. When you sell in a high income year, those gains can push you into a higher bracket or trigger the net investment income tax. It's a 3.8% surtax on certain gains. But with planning, you can spread those gains over multiple years, offset them with capital losses, or defer them by reinvesting through qualified methods. For example, suppose you're planning to sell an old X-ray unit and replace it with new technology. You could time that sale right before buying the replacement, pairing the gain from the sale with the new equipment deduction, so your overall taxable impact is neutralized. Or let's say you own your clinic building personally and are considering selling it to your S Corp or a new entity. Structuring that transaction correctly can prevent you from paying unnecessary depreciation recapture and shift timing to when your income is lower. The key message here is that capital gains shouldn't be an afterthought. You should always be asking, if I sell this now, what year's return will it affect? And what can I do to soften the impact? That one question can save you thousands. Um, Federal strategies can get all the attention, most often do, but state level credits are often where the unexpected savings hide, especially if you operate across state lines or have multiple entities. Texas itself doesn't have a personal income tax, but practice owners often forget about franchise tax and local credits tied to hiring, property investment, or even sustainability efforts. For example, there are property tax exemptions for certain energy efficient improvements or agricultural uses that can reduce your annual burden without affecting your federal return at all. If you have any activity outside of your state, like a satellite location, real estate, or remote employees in states such as Oklahoma, Colorado, or California, those states often have credits for small business investment, job creation, and equipment purchases. These aren't gimmicks. They're designed to attract and reward small business growth. Another overlooked area is continuing education and R&D style incentives. If your clinic invests in process improvements, diagnostic methods, or medical protocols that involve experimentation and data collection, even on a small scale, there's a chance those expenses could qualify for a research and development credit under federal and state guidelines. In short, don't assume your CPA or accountant is checking for these automatically. Many generalist firms skip state level research entirely because it's complex or time consuming. So you should ask about it, especially if you've expanded locations or added some new services. The payoff from one small credit can cover your next piece of equipment or staff training budget. The fourth strategy can really make or break your long-term tax plan. So for veterinary S corps especially, your reasonable compensation decision has a major ripple effect. The problem that I see repeatedly is that someone will set their payroll amount the first year they elect S corp status and then never touch it again. Meanwhile, the business doubles in size, revenue grows, distributions balloon, but the W-2 wages stay the same. That's a red flag for the IRS and a missed opportunity for balanced tax optimization. Your goal should be to hit that sweet spot where your salary reflects your actual work, but doesn't necessarily or unnecessarily inflate payroll taxes. Too high and you're overpaying FICA, too low and you invite scrutiny. There's also a strategic layer that most people miss. Your salary affects what you can contribute to your retirement plan and what you qualify for in future credit or loan applications. So I often recommend doing a reasonable compensation review every 12 to 18 months, especially when your practice adds doctors, locations, or shifts its revenue mix. Adjusting your compensation mid-year can smooth out your quarterly estimates and give you a more accurate reflection of how much cash flow you really have to reinvest. And if you're a multi-owner practice, this conversation becomes even more important. Unequal or outdated salary splits can cause both tax imbalance and partnership tension. The bottom line here is how you pay yourself isn't just a compliance question. It's a powerful lever for tax control, retirement planning, and financial stability. The fifth strategy is probably the most important shift you can make. Once you start earning real money in your business, reactive tax planning just doesn't work anymore. The business world changes constantly. New credits appear, tax laws adjust, your income fluctuates month to month. If you're only looking at your books once a year, you're seeing everything in the rearview mirror. So year-round planning means you're making decisions in real time. You're checking your profit margins each quarter, forecasting your taxable income, and deciding when to make purchases or fund retirement instead of waiting for your preparer to tell you what happened. It also means having regular financial check-ins, even brief ones, to look at where your money is going, how much you're setting aside for taxes, and what opportunities are opening up as your income shifts. That's how you stop getting blindsided in April. In my firm, we use tools like rolling cash flow views, margin floor reviews, and entity level diagnostics to keep clients ahead of the curve. When you understand your practice's numbers, you can see in advance when your tax bill is going to spike, and you can make moves now, not after the fact, which allows you to make moves. It allows you to choose what your moves are, gives you choices. So the biggest takeaway here is that taxes aren't something that just happen to you. You have more control than you think, but that control only exists if you plan ahead. So there you have it. 5 ways to keep more of what you earn, even if your tax bill keeps growing. So the first, just to recap, is to be intentional about your retirement contributions. The second is to time your capital gains wisely. The third is to take advantage of every credit you qualify, especially at the state level. The fourth is to review and rebalance how you pay yourself. And fifth, and most importantly, is to plan year-round instead of reacting at year-end. Each of these strategies can create real savings on its own, but together they can transform how you experience your finances. You move from feeling drained by taxes to feeling in control of your outcomes. If you want to see how these apply to your own situation, how to align your income, your deductions, and your timing for the biggest impact, you can book a free profit and cash flow analysis session with me. In that session, we'll walk through your numbers together and find the opportunities that are specific to your practice. You can grab a time, at the link on your screen. I'll also drop it in the comments. And if you found today's live training helpful, make sure to follow me on my Facebook page for more weekly sessions like this, where we'll make the business side of veterinary medicine a whole lot clearer and a whole lot more profitable. Before you go, I want to share an incredible resource designed to elevate your veterinary practice's financial success. I've put together a free ebook just for you. It's called 7 Financial Strategies. Inside, you'll discover practical steps to increase profitability, improve cash flow, and make smarter financial decisions for your practice. You can grab your free copy in the comments. Thank you so much for tuning in today. If you found this helpful, like this video, share it with other veterinarians. If this is something you'd like to implement in your own practice, don't forget to book your free call. In that call, I'll get you the info you need to help you get things set up correctly. Next week, hopefully on Wednesday, we are going to do our next live training. That training topic is 8 hidden expenses draining your veterinary practice. and how to stop them. Thank you so much again for tuning in today, and I hope you guys have a great rest of your week.